I think we want regulation to be as efficient as well as effective as it can possibly be. Regulation is not free. Good regulation has very positive benefits, avoiding financial crises, avoiding consumer harm and things like that. But nobody benefits when regulation is inefficient. And so we've taken the job, particularly for the smaller institutions, going back and looking at everything we've done over the last decade to make sure that we're doing it in the most efficient way possible. That's what we're doing. We want the strongest, toughest regulation to apply to the biggest banks, particularly the 8 SIFIs. And then we want to make sure that we've tailored appropriately as we move down into regionals and sub-regionals, and then large community banks and smaller ones.
So fair answer. What would you say to someone back home who says, why would the Fed focus on this? Why would the banking committee focus on this? Why would the federal legislative branch focus on making life easier for the banks, given income inequality, given that these are literally the most profitable institutions in American history? I get that it's always better to make things more efficient. It just seems like you have limited resources and we have limited political capital to spend on priorities for the Fed. What do I say to someone back home who says, why are you taking care of these guys who seem to be, feeding at the trough pretty nicely?
Well, I think you have to distinguish between different kinds of institutions. I don't think that the smaller community banks are maybe feeling quite as healthy as you're saying. I think they are healthy, but I think we want them to be devoting their efforts to making loans and investing in their communities, supporting economic activities in their communities.
But lending is up, right? And profitability is at least somewhat of a proxy for the efficiency of the regulations. I won't belabor this. I take your answer in good faith. In a recent interview with Marketplace, you were asked what keeps you up at night. This is one of the things I enjoy about you is you're frank in your responses while trying to stay in your lane. And you said, we face some real longer-term challenges, again, associated with how fast the economy can grow and also how much the benefits of that growth can be spread through the population. I look at things like mobility. If you judge the United States against other similar well-off countries, we have relatively low mobility. So if you're born in the lower end of the income spectrum, your chances of making it to the top or even to the middle are actually lower than they are in other countries. Understanding that the Fed cannot address these issues squarely, can you talk a little bit about income inequality and what ought to be done? And then my final question around income inequality is whether, to the extent that you've expressed this view, a tax cut that provides about $33,000 for individuals in the top 1% of earners and about $40 to the poorest of the poor, whether or not that helps or hurts in terms of income inequality.
There are a range of the question I was answering in that interview and that you're really asking is really these are issues that the Fed doesn't have the tools or the mandate to fix, but they nonetheless involve significant longer-term economic challenges. So I just would, I pointed out low mobility, which is the research of Raj Chetty, who's a professor back at Harvard now, and also there's just a stagnation of median incomes for a long time. And if you look at things like labor force participation among prime-age males, you've seen a decline over 60 years. So these are unhealthy trends in the U.S. economy that we don't have the tools to fix. You do. These are things for the legislature to work on. And it comes down to things that are easy to say and hard to do, like improve education, deal with the opioid crisis, things like that. And I also think, balanced regulation plays a role in this and in enabling capital to be allocated freely and people to move from job to job. All those things go into it. But these are long-run important issues. Particularly, another one is the potential growth rate of the country, which is looks like it's slowed down because of aging, really, and demographics and things like that. So these are big issues. We can't really affect them with monetary policy.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.